Good afternoon. I wanted to address kind of the current global economy, what's going on in the world. We know that there's a lot of uncertainty out there, so I just wanted to send out a video message. I did the same thing during COVID, just to kind of be able to ease your thoughts and minds about what all is going on. So as we saw last time during COVID, we like to look at these things as opportunities. I know that sounds funny sometimes to think of them as opportunities, but really in these moments in life, that's exactly what we have to look at. Think back to COVID when we first started experiencing a global pandemic, and we actually saw the world as we know it shut down and go into lockdowns, and what that may mean. And that bred fear in people, and many people were like, should I get out of the markets? What should I do here? And the economists were saying, hey, there's nothing that's pricing into the market. This is a fear-based sell-off, and it's a V-curve scenario. Instead, look at it as an opportunity. And that's exactly what we did in 2020. We looked at it as an opportunity to do certain moves, which we'll talk about here in a little bit. So I just want to make sure that we remind ourselves that strategy is paramount, and that's why you have put into place into your lives a holistic financial advisor, one that utilizes the markets in these downturns to actually look at things and find where can we find value in a dropped market. We use technical and fundamental analysis along with chief economists, because I certainly cannot do it all, to help us steer the ship when things become uncertain and waves become great, if you will, in the marketplace. So that's what we're going to talk about a little bit today. The S&P has come down 12.35% since the beginning of the year. So we are in correction territory with the S&P 500. The Dow is down 9.95. We're down 18.88 on the NASDAQ. So technology stocks, the tech sector, has definitely taken the biggest hit so far this year, which we were heavy in up until about February. We have already made some strategic moves to change out of some of our tech-heavy sector of the marketplace as well. So just so you know, this is kind of a broad market downturn that we're currently experiencing. The concern tends to be that it's kind of like a trifecta going on in the marketplace right now. We have a war, right? We have Russia invading Ukraine, the potential of it turning into a world war if they set foot into Poland. We have inflation that seems to be rampant because we haven't experienced it for so long, really since 2007, 2008. We've had the Feds controlling our interest rates to a degree where we've had no real inflation. And then interest rates, because we've been in a zero rate environment for so long, they have to raise the rates. So with these three things, or the trifecta of interest rates rising, inflation, cost of everything going up, and war, people get concerned. I hear sometimes people ask me the question, you know, what if we go through another Great Depression? The Great Depression did not have monetary policy in place. So the monetary policy, and I think a lot of people do not understand or realize, that monetary policy was created after the Great Depression. And it was created because really of the Great Depression, because back then there wasn't a control system in place to say, hey, we need to tweak some knobs here. You know, money supply is too much, there's too much money in the system, so we're going to raise interest rates so people will not borrow as much, and the money supply will shrink. That will cause inflation to go down. So they put these positions in place to kind of control the marketplace, if you will, and that's what we're going to have to see now. We're going to have to see interest rates come up because of the amount of money that's been pushed into the system. There has been 40% new money printed since the beginning of COVID. 40%, and if you look at that, you have to understand that there's going to be probably 40% cost of good increases over the next 10 years. Our current economists are suggesting that we should probably experience somewhere in the neighborhood of 6 to 8%. We're looking at potentially 7 this year of inflationary rises. The cost of goods will go up. We were actually in a zero trending inflationary period, like I said, since 2008, 2009. So we were under trending inflation for a really long time. No one was really raising their prices. And now all of a sudden there's this huge supply of money. We all know who it went to. We all know that it was just kind of like Oprah, like here's some for you and here's some for you and here's a gift for you, whether you needed it or not. There was definitely people during the pandemic that needed that money, but to just pass out money like crazy does not make sense to a lot of us. And now we're going to pay the price for that because there was a flood of money in our system and not enough goods. And then you add things like the current situation in Ukraine, where we're putting sanctions and heavy sanctions on Russia, which means that we're going to have an even tighter supply, but we have plenty of money out there in the system. So we're going to continue to experience this inflationary pain, if you will. One, we were under trending inflation for a long time, so this is a natural occurrence. Two, the Fed's kept interest rate at artificial lows for far too long. We could have priced in interest rate hikes. COVID did not end up causing some sort of massive market decline over a long period of time that said that they should have started raising the interest rates already. So now they're playing catch up. So we are going to experience things like interest rates rising to try to help taper, if you will, the inflationary experience that we're currently having. We all know that you're going to your restaurants right now and feeling like they've raised their prices, not 6%, not 7%, but 20 and 30%. That is because no one was raising their prices for so long because money was cheap. You could borrow it at 0%. So why wouldn't you put loans against your house and create an excess of money flow? So that is going to be a big change coming up to our system, really, and a shock to our systems, if you will. But I want to talk a little bit about what I did in 2020 during COVID. I call it my COVID response. My clients, you got these videos from me about every week during the first 3 or 4 weeks of COVID in March during the shutdown periods, to talk about all the different changes that was going on. One, it wasn't just fear back then, but we had a lot of legislation changes, a lot of policy changes going through our marketplace, a lot of incentives, if you will, for people that I was making sure you guys were all aware of. We don't have that going on right now, so there's not legislation changes on the pike that we need to talk about, but it's more about where the strategic moves need to be. So back in 2020, my COVID moves were process Roth conversions. Chief economists were suggesting it was going to be a V curve, meaning the markets were going to drop very swiftly and come back very quickly. That's what happened. So we processed 120 Roth conversions for our clients in March of 2020. All those returns in the stock market happened tax-free. So guess what? Take advantage of the marketplace. We're now, I talked about the percentage we're down, especially in the tech sector, down almost 19%, almost 13% down on the S&P 500. We are looking at processing Roth conversions again early this year. It does put a lot of pressure on the company here at the office. My staff certainly loves when we have to process these in one fell swoop earlier in the season. But I think it's important that we go ahead and look at doing Roth conversions earlier this year. One, the markets have dropped, so we're going to go ahead and price this into a lower drop. So when the markets recover, the recovery will happen in your Roth accounts completely tax-free. And two, if I can get these done prior to the tax season ending, I may have you guys reach out to your CPAs to set you up for estimated payments once we talk about how we want to pay the taxes on the Roth conversion process itself. So that was one move we made in 2020, and here I am sitting here saying we probably need to make it again. And here we are in March again. So March and April of this year, we're probably going to be looking at doing Roth conversions. Go ahead and getting those out of the way. The other thing I said in 2020 was to front load your guys' 401ks or your employer plans. You guys all have your stuff set up to put your contributions in over the entire year at an equal pace. You can, again, be strategic and front load your 401ks. I don't want anyone to front load it to the degree where they're not still putting something in throughout the entire year. But let's say you're putting in 10%, your company only matches you 3%. I want you to go ahead and front load as much as you can into your 401k. Maybe it even looks like you skip a couple of paychecks and you completely push as much as possible in while this market is down. As long as you're still putting 3% in by the end of the year, you'll get your full 3% match. So I recommended it back in 2020, and I'm recommending it again to look at front loading your employer plans so you can buy more dollars into this downward market. Another thing that I told people to do back in 2020, and now this is the one that's completely the opposite. So in 2020, the feds were saying, hey, we're going to lower rates. I don't think they should have lowered rates, but they were saying, we're going to lower rates. We're in a pandemic. We need to control things so the markets don't go down. So they did. When an interest rate is decreasing, okay, so when interest rates are going down, we wanted you to lock your money up like in CDs or fixed annuities at a longer term product because you were going to lock in a higher interest rate because interest rates were going down. Back then in 2020, we could get a 3-year fixed annuity for 4.25%. A lot of my clients, we moved money out of CDs, we put them into these 3-year annuity products, getting 4.25%. And you have certainly not been able to find anything with paying 4.25% for the last 2 years. You're lucky on your CDs to be getting even 0.5%. So the move to make when interest rates are decreasing is when it comes to money that you have to invest, you lock it up for a longer term. Now, borrowing is the opposite, right? So when you're borrowing money, you want to kind of wait. If the interest rates are set to decline, you want to wait to refinance your house, to take out a new loan till the interest rates have fallen. But now we're in the opposite storyline, okay? We're in a storyline where interest rates are going to go up. So interest rates going down, you go long duration. You put your money in investments that are longer time horizon because you're locking it into a higher interest rate. When you borrowed money, you didn't want to go very long because interest rates are supposed to be going down. Flip-flop to 2022, we're going to do the opposite now. Now we need to be in short duration investments. When you're looking to buy something, you don't want to lock your money up into 3 and 5 year rates, because if interest rates are set to increase, we don't want to price ourselves into locking in these lower rates right now. So when you're talking about your money and your cash and your CDs, your bonds and your annuities, long duration is not the place to be, because who will want to buy your bond if you buy it today at 1%, when interest rates go up and 2 years from now someone can buy a new bond at 3%, no one's going to want to buy your bond at 1%. So we want to be short duration on investments when it comes to our fixed income assets right now as interest rates are increasing. And it's the opposite when we talk about loaning money or borrowing money. So now we're looking at interest rates going up. Do we really want to wait a year or two to see where interest rates go, or should we go ahead and lock in long duration rates now on loans? So if you're a borrower, if you need to refinance your house, if you need extra cash flow, so you're planning on pulling equity out of your home, if you're planning on buying that vehicle, any kind of loan scenario, you want to get into your banks ASAP. The feds are raising rates this year. It will happen. It has to happen in order to put a tamper on inflation. So locking money up on a long-term process for loans, going very short duration for money. So these two things is, once you have the money, you're giving it and needing an interest rate for it. That needs to be short duration right now as interest rates increase. You borrowing and being the borrower of money, you need to go ahead and lock that money up. On the mortgage conversation, I want to say this. Many people want to go like a shorter duration, 15-year home mortgage, 10-year mortgage. So this isn't just for my clients, but this is for you to talk to your kids about this too. With inflation, price of things go up. So your own money supply or your kids' money supply is not going to go as far. When you go to fill up your gas tank, it takes more of your money. Things are going to cost more. So you may want to consider, again, right now, if you're at 4% or 3.85% on a 30-year mortgage, that's going to feel very cheap in the next coming years. So it's going to feel very cheap. So maybe you give yourself the opportunity to go into a 30-year mortgage. You can always pay more than one payment per month. So you can buy your interest rate down by making 2 payments a month and making it a 15-year mortgage. But it also gives you the ability to maneuver your cash flow. So if things continue to price higher and higher and higher, and you start to feel that burden of your cash flow, your money is not going as far as it used to, because that's what inflation does, then maybe that it gives you the opportunity to still make your baseline mortgage payment, but it's giving you the opportunity to make those extra payments or not, versus a static higher payment no matter what. So give yourself a little wiggle room right now with inflation going up, to allow yourself some extra cash flow that you can maneuver or wiggle. So that's another thing. Those two are the opposite. We had decreasing interest rates in 2020. We're now heading into increasing interest rates. So those are two very different things. Make sure you spend your money wisely and save it wisely. The other thing in 2020, the economists that I like to listen to, before COVID really hit the United States, this was February of 2020, said, hey, if we experience what China is experiencing, and it makes its way to the United States, there's some sectors of the markets that are going to fare very well while everything else kind of takes an initial hit. So in February of 2020, we knew that if we experienced something similar to China, aka the shutdowns, that technology, these videos, Zoom videos, people working remote, was really going to take off. And that, you know, some medical supply companies that were beta testing the vaccinations would do very well, and some other things like hand sanitizers and Clorox would do well. So in February of 2020, I bought and I sold off some of our S&P 500 index funds, and I bought some strategic sector maneuvers. I bought Madeira, and I bought Clorox, and I bought Zoom Video. And it was kind of a hedge piece. It was a small sleeve of our investments, but it was a hedge piece to say, if we have and we experience what China has experienced, let's set ourselves up to be able to weather this storm well with some investments that are going to be going up while everything else is going down. It's no different right now. Sector modeling says that while we keep everyone diversified and broad-based diversified investments, you can have sleeves or sectors of the marketplace that you own at different times in the market seasoning. So technology has been a wonderful sector for us. We've made a lot of profit on technology for the last 10, 15 years now, but it was time to harvest out of some of our tech because we've made a lot of profit off of it. So I harvested out of some of our tech funding back in February, and I bought into oil, gas, consumer staples, and commodities. The reason why I did that was before Putin even invaded, right, Ukraine, we knew that just with inflation going up and interest rates going up, that people will maybe at some point stop spending quite as much. As the prices of things go up, even though we now have an open economy, so we've got kind of two things kind of going back and forth here. We have inflation prices going up, but we also have COVID that's now kind of making its way on the downturn and opening our economy back up. People are back out shopping, going to dinner. So you kind of have these two things working against each other to kind of keep things a little bit more stable. People stop spending so much on things that they don't need, right? So things that they want but don't need. Instead, they're going to put their money more towards things that they absolutely need. No matter what, you do need to put gas in your car, or you need to pay for electricity if you have an electric car. You still need to go to the grocery store and buy food. There are consumer staples. The consumer staples area of the marketplace are things that you're always going to have to go to. So in different market cycles, we have peaks and contractions and troughs, and we have these different market sector cycles. And in those different cycles, it's kind of, you can look back through history, certain areas are going to do better than others. So I am not the advisor that's going to sell you to cash and hide under a rock. I am the advisor that is going to be strategic to say that, hey, where are we heading? Not where have we been. We know where we've been for the last 12, 13 years. We knew that it could not continue to go at 18% average rate of returns. We knew there would be a price change in our system. So you need to go towards the sectors that are strategic in nature. As with anything, if you're in the stock market, there's always risk associated. There's risk with bonds, there's risk with stocks. The only things that don't have risk are going to be checking, savings, CDs, and fixed annuities. And then you're at the crediting company's ability to repay their own loans as well. So if you have short duration money, this is my last point I may want to make here, you don't put into the stock market what you intend to spend. Meaning, if you intend to spend money in the next 3 years, don't put it in the market, because the markets can go either direction very quickly. If you put money into the market expecting to always get a rise from it, and you think that you may need to spend it in the next 6 months, do not invest it. You should always understand that the market's volatility, no crystal ball works for anyone. The markets can rebound in the next 3 months and we can make a lot of profit, but they could continue to decline for the next 6 months. No one can tell us exactly when the recovery will happen. All we can say is we look at the policy, we look at profits, we look at PE ratios. Are our companies making money? How are our profits of our economy? How is our unemployment? That's what steers the actual marketplace. How much interest rates can we see them increase without the S&P 500 and the stocks carried within being overpriced? That's what we look to on the stock market side, but you can't put money into the market expecting a very quick return, because you could also lose very quickly as well. That is what I call gambling. Money in the market should be long-term. There should be thought behind everything that you own, and that you should always think about, do I have enough in the bond side Okay, the bond side, or the cash, checking, savings, CDs, fixed annuities, and bonds are what we call conservative investments, and it's in one hand. And think of your stocks in another hand. And when the markets are good and the stock is rising and we need to give you some money, we may as advisors harvest out of the hand that has gone up. But if the markets have gone down, this bond conservative hand usually is fairly stable, and you need money, then we tap into this hand. At any given time, it's like scales, you have to make sure that you've got money in both of these hands. The money that's in this hand should always be at least 3 to 5 years worth of any income that you may need. If you need a withdrawal and you need to buy a car, you need monthly income. As an advisor, my golden rule is to keep 3 to 5 years in this stable hand, because it allows me then to cherry pick when the markets are doing this or this, which hand we strategically want to pull from. That allows you as the consumer to never be selling stocks in a downward market, that is when you truly lose, is when you sell in a downward market. So it's important that we remain calm. It's important that you give strategy behind your investments. And the most important thing is that you do have a long-term financial plan. So you want to make sure that you've worked with financial planners to lay out your financial plan, that we're aware of all the needs that you may have over the next 3 to 5 years, so that if we do in fact go through a recession, let's say, the average recession recovers in 3 to 5 years. So you need 3 to 5 years worth of your income needs in a very stable environment. We never just rebalance and give you a little bit of everything. I'm a very strategic advisor from the perspective of you dollar cost averaged when you bought into the markets. But I don't want a dollar cost average on the way out. I want to be strategic. We pull from the conservative hand when the markets are not doing well. We harvest gains on the stock side when the markets are doing well. You also will see me always rebalancing when I do go in and kind of put things back into tolerance for people. I do it strategically at market highs. I don't rebalance and sell stocks during market drops like we're currently in. We want to make sure that we're harvesting out and replenishing the conservative bucket during market highs. So again, my job as your advisor is to keep you well diversified. I'm not timing the market. We won't time the market, but we are going to utilize the data from our economists and our strategists to make sure that we're investing in the right market sectors so we can get the most for our money. We don't sell with fear or run to cash. We don't do things like that. We stay diversified and we stay the long-term plan. We just do it very strategically. So if you are someone that is having trouble sleeping at night, because of what's going on, I would probably say that you weren't investing potentially the right way in the first place. But if you are looking to make a more conservative move, we need to sit down and have a plan of action for that. Just going conservative due to fear in the middle of a correction is never a wise move. If you feel that you need to be more conservative long term, again, we should have already laid out a plan for that. So most of my clients have all of you have financial plans. I know that you're not worried because we've already set aside the money that you may need to tap into for the next 3 to 5 years. And I take a lot of pride in the designing of these financial plans and the education that we pour out to you guys to empower you to make sure that no matter what's kind of going on in the marketplace, that you don't feel the need to worry. So I want to thank everyone for listening. I'll probably put another one of these videos out at some point, depending on kind of what happens, or if Russia does in fact step foot on Poland's grounds and we go to a world war. We'll then be looking for other strategic moves, because again, history's shown us a couple of things, that even during war years, the markets tend to price themselves positively. You can look back through history. Attached to this email, I'm going to, like I said, attach some information for you guys to look over, some pieces that just give you facts so that you don't listen to different people on the TV and different people that you're talking to. Fear tends to breed itself. A very wise investor, a little well-known guy named Warren Buffett, has always said, when everyone else is fearful, be greedy, and when everyone else is greedy, be fearful. So it is a good time to just kind of take a step back and look at everything. If you have any questions, feel free to call our office. Otherwise, everyone that's already marked for a Roth conversion, our office will be calling you to find out what your income was for this year so we can take advantage and process the Roth conversions in this down market. Have a wonderful day.